4 safe stocks that will 2x or more in the next 12 to 36 months. That's what we're about to get into in this video here today, folks. I wanted to come up with a list of stocks of companies that, let's just call it, because there's always a lot of opportunities in the market to maybe 2x your money or more than 2x your money, over a given span of 1 to 3 years, let's say, for instance, right? But some of those ways might be very concerning in terms of keeping you awake at night, right? These 4 companies we're going to go over today are very safe business models. They're business models that have proven they can make it through recessions, they can make it through high inflationary environments, they can really make it through anything, just to be quite frank. And they're the type of business models that are extremely profitable, and they're the type of business models that aren't going to keep you awake at night. Let's just put it that way, okay? So that's the type of list I want to put together for you guys here today, okay? Now, one other thing I'll say before we get going in this is, of course, if there's some sort of big recession in the next 1 to 3 years, then these stocks, will have trouble doubling in that sort of market, right? But you could always say that for any given market. I mean, if you have some sort of big recession that happens, a great financial crisis or something like that, that can mess up everything. So that's just, always a risk you got to be willing to take. But these are the type of companies that it doesn't matter. Throw recessions at them or whatever, they get through the other side and they make it out stronger than they went in, okay? Appreciate y'all joining me here today. Hope you enjoy this video. Hope you really appreciate it. All I ask in return, smash a like on this video and make sure you're subscribed here to the channel, okay, for these sorts of videos that I like to put out for you guys. Also, I got a brand new workshop for you. Pin comment down there if you want to enjoy that when this video is over. It's absolutely free to access that. It goes into how much money you need to retire, focus on investing full time, quit your job. All those sorts of subjects are covered in that video. So that's pin comment, absolutely free to access that when this video is over here today, okay? All right, guys, so let's get into this. First one up here is NVIDIA. Yeah, I know a lot of people are like, no, they've been trying to top call this stock since it was 150, 250, 350, 450, 550. They keep trying to top call it. The problem is they don't, all these people trying to top call this stock over this past year, and they're still trying to do it. They don't even understand what's actually going on with NVIDIA's business model right now. And they don't understand that NVIDIA's business model is actually one of the safest business models in the entire world at the moment. And the reason being is, guess who's NVIDIA's customers are? The biggest customers. Guess who they are? They're the strongest, most well-capitalized companies in the entire world. They're the type of companies that you wish, if you ran a business, these would be your customers. Microsoft, Google, Meta, Amazon. Now, NVIDIA's got a ton of customers outside of those, but those are its biggest customers. These companies have unlimited funds, and they're already committed in their budgets for 2024, massive expansion in terms of how much they're going to be spending on chips, and guess who they're going to be spending the money with? It's NVIDIA. NVIDIA's not the only one. AMD obviously can benefit a little bit this year as well, but it's just small. It's small potatoes, just to put it quite frank, compared to how much NVIDIA really benefits from this. So NVIDIA is selling shovels to the strongest, most well-capitalized companies in the entire world. And I mean, that's the ultimate. That's literally the ultimate, right? Imagine you're a credit card company and you got to hope that Joey keeps his job down at the Whirlpool factory or he's not going to pay his bill, right? That's a little scary. When you're selling chips to Microsoft, who's going to invest billions of dollars regardless, that's pretty comforting because they're good for it. They're gonna pay you your money, right? Now, the other thing I'll say about this whole situation is there's a false assumption that everybody is just going to magically catch up to NVIDIA or something like that, right? And you just don't understand technology if you think like everybody's just going to magically catch up to NVIDIA. Like, there's a lot of these same companies want to create chips, and they'll be able to create chips, but not to the level that NVIDIA has. They're trying to catch up to where NVIDIA was, right? Not to where NVIDIA is going to be 3 years out, 5 years from now. So it's flawed thinking. It's like you're running behind Usain Bolt and you're like, I'm going to catch up to him. No, his lead's probably actually expanding right now while you're getting further and further back. You think you're catching up, but really his lead is expanding over to you further and further and further. And so that's the way I'll put it in regards to this whole situation. And anybody that really understands the tech behind this realizes you don't just magically create an H100, H200, or what NVIDIA is probably going to show off next year or the year after, the H300, right? Now, speaking about H200, this is about to essentially launch in terms of, start to hit NVIDIA's numbers here very shortly. And you're going to start to see it in a major way start to hit its numbers in the back half of this year in 2024. Now, the H200 is much more powerful than the H100 chip. And this is going to be something that, guess what? All these big dog companies are going to be upgrading to. They're going to want H200s. H100s are cool, and that's awesome. But if you need to be in the front of the game, then you're going to have to have H200s. H200s, let's just think about this logically. Do you think NVIDIA is going to sell those chips for a cheaper price than it was selling the H100s? Well, remember, the H100s were reportedly going for anywhere between $25,000 and $40,000 each. So, the moral of the story is the H200 is likely going to be selling for a minimum of $40,000 each, right? Which means NVIDIA's margins could even expand again over the next year to year and a half. And its revenue is going to obviously continue to increase dramatically, and the profitability will increase dramatically as well. And keep in mind, NVIDIA is going to sell every single H100 they can get their hands on this year. It's just the next level is now the H200 at this point in time, right? Now, another false thing that I see a lot of people doing is they try to compare this company to where it used to be in terms of, the stock price has gone up so much. Well, guess what? The company's business model is not even in the same category that it used to be in. If we go back to the January quarter of 2023, they did $6 billion of revenue. This most recent quarter, they did over $22 billion of revenue. That's, well over a 3x. That's nearly a 4x in their revenue. Gross profit went from under $4 billion to nearly $17 billion. That's over a 4x in gross profit there. Absolutely unbelievable. This is not even the same company now at this point in time, right? Now, the other great thing for NVIDIA is they're still growing every single quarter, not just on a year-over-year basis, but on a sequential basis as well. Now, someday this is going to end, and they're not going to be growing on a sequential basis anymore, and that will be a day when NVIDIA's stock price will potentially get hit, because people will be like, oh boy, the sequential growth is over. But for now, it is growth, growth, growth. They went from $6 billion revenue to 7.1 to 13.5 to 18.1 to this latest quarter over $22 billion. This next quarter they'll report is probably going to be 25.5, somewhere around there, probably $25.5 billion of revenue. Maybe higher than that, we'll see. And so the company keeps growing on a sequential basis quarter after quarter. And then gross profit, same exact situation, from 3.8 billion to then 4.6, 9.4, 13.4, and nearly $17 billion in gross profit in this latest quarter, right? And so this is going to continue, in my opinion, for at least this year in 2024. Now, the question mark is 2025 for NVIDIA. Does the company at some point in 2025 stop the sequential growth when it comes to gross profit and revenues? That's a potential. I think that's the big wild card. I think by the time you get to probably 2026, I would say there's probably a pretty high probability of that. 2025 is question mark. So this year, I think we're good. I think in terms of revenue and gross profit and net income going up every single quarter after quarter after quarter, we're still safe as far as that goes. And so there's nothing to worry about in regards to that, right? Now, also the company's operating income is increasing much more rapidly than their revenues and their gross profit. Operating income, for instance, over 10x'd on a year-over-year basis. And then if you look at their net income, it nearly 10x'd on a year-over-year basis here recently. So when your bottom line is increasing much more rapidly than your top line or your gross profit, that's a very good sign and very good signal overall. Now, here's the next part of the story that matters significantly. The company has now had double beats 5 straight quarters. The last 3 quarters have been insane double beats. 61-cent beat on EPS, 63-cent beat on EPS, 53-cent beat on EPS, $2.4 billion beat on revenue, $2 billion beat, $1.5 billion beat. So what this company's proving is quarter in and quarter out, they're coming through and they're beating numbers. Yeah, they're going to put out their projections. Those projections are going to likely beat whatever analysts are expecting, but then they're going to come through and then beat it on top of that, which is just ridiculous. And they're doing this quarter in and quarter out. At some point, this will end, but for right now, it is just quarter in and quarter out. Now, if you know this company is coming in and they keep beating guides, right? They keep beating where analysts are expecting the company to be. And then they come in and then beat those next expectations that analysts then project out. Then guess what? Analysts are probably going to be far off in terms of their EPS projections for the company for this fiscal year we're in right now and next year as well, right? Now, the company's trading far too cheap in general based upon the growth rates that this company has. Even if it has a fraction of the growth this company has right now, still it's trading way too cheap at 37 times. This current year we're in, forward P, that's way too low, way too low. Even like I said, even if this company's growth was not even remotely close to where it's at, it's still too low for this company. Now, once again, analysts, this is based upon analyst projections. Do you think they're really doing $24.59 of EPS for this year? I mean, analysts have been massively wrong 5 straight quarters, but really insanely wrong last 3 quarters. So they're probably going to be wrong again. So there's maybe NVIDIA does a 26, a 28, maybe a $30 of EPS this year, right? Maybe a $32 of EPS, which guess what? Then puts it at even a far lower forward P than what it says right there at 37, which is once again already far too low for this company, right? Now, on top of that, 7 straight quarters of much higher EPS. And I don't see this ending at any point, at least in 2024. They went from 51 cents of EPS to then 58 cents, 88 cents, $1.09, $2.70, $4.02, $5.16. This current quarter we're in right now, I mean, lowest expectations I would say is probably $5.50, but there's a decent probability they could do $6 plus of EPS. In this next quarter, they're going to report, right? And then probably pushing towards $7 or $8 and $8 to $9 the following quarter. So, when those H200s hit, just look out, okay? Look out when those H200s start to hit. So the moral of the story is EPS keeps going up on a sequential basis and isn't going to stop, at least in the short term, right? So overall, I will say, for NVIDIA, the day of reckoning will be coming for this company. But it's not coming in 2024. When I say the day of reckoning, I'm talking about what the bears talk about. The 50% type decline in this stock, where over a 6 or 12 month span, NVIDIA stock goes 50% down, 50% plus. That happens to NVIDIA. It's happened before. It will happen again. The day of reckoning will come for NVIDIA. But it's not in 2024. This is another year of ridiculous growth, of ridiculous beats for this company. And at the end of the day, very shortly, people will be trampling over themselves to pay $1,000 for NVIDIA stock. Then they're going to be trampling over themselves to pay $1,250. And then they're going to be trampling themselves over to pay over $1,500 for the stock. And we're not talking about over the next 10 years. I'm talking in the very short term. That's going to happen. And as this company continues to come in, beat, people understand the story more. They're going to be willing to pay more and more and more for this stock. So when I look at NVIDIA, it is set up very, very well for at least the next year. After that, we can talk. But for this next year, it's you just got to get out of the way of it. That's all I can say about that. Okay. Alrighty. So that's first one up here. Next one up here are these safe stocks that has some incredible upside potential here over the next 1 to 3 years. Is one you might not think about. It's Cheesecake Factory. I expect the stock to over double in the next 1 to 3 years. Yes, indeed. Now you might be thinking, restaurant company, I don't know. Could a company like that really double in such a short amount of time? Because you think about an NVIDIA, or you think about some sort of e-commerce company or companies like that. And it's like, okay, see how they could, scale quickly, some sort of SaaS product, but a restaurant chain? Here's the deal, okay? Let me first take away that false belief of thinking restaurant chains can't double rather quickly. This is a 5-year chart of Texas Roadhouse. The stock has gone up 132% in the past 5 years, with much of that coming really in the last 4 years. This is Chipotle. This is a 5-year chart of Chipotle. Chipotle is up 340% in the past 5 years. This is Wingstop. the most average wings you'll ever get. I'll say that. I've had Wingstop many times, and every time I ever go to Wingstop, I think, dang, this place is average. And man, the stock price is not average, I'll tell you that. 435% gain in the past 5 years on this one. Shake Shack, this is a 1 year chart of Shake Shack. Just in the past 1 year, Shake Shack has gone up 77%. 1 year. So don't, take all limiting beliefs about restaurant chains thinking these stocks can't increase dramatically over a 1, 3, or 5 year span. Take that right out, because factually they can increase rapidly, and I think that's what's going to happen here with Cake. Now, in regards to Cake, the forward P on the stock's about 12. This is one of the things that gives me conviction in believing that this stock's going to likely double up here in a very short amount of time. If this stock was trading at a 25 forward P, I feel very, very differently about the company. Texas Roadhouse, for instance, trades at a 27 forward P. Chipotle trades at a 50 forward P. Darden Restaurants trades at a 20 forward P. That one's, I guess, a cheap one, which, if I compare Darden to Cake, I mean, Cake's going to massively outgrow Darden over the coming years, in my opinion. So just crazy that stock trades that rich compared to Cake. Wingstop trades at a shocking 124 forward PE, and the craziest one of all of them is Shake Shack at a 151 forward PE on that stock, okay? So one is Cake just has a lot of valuation catch up to play here as people understand the story better. Now, there's 3 core ways that Cake's going to grow over this next few years. The first way is the traditional Cheesecake Factory restaurants. They still have more location opportunities in North America and international specific. Because Cheesecake Factory is such a famous brand, they're going to be able to expand that more and more with licensed locations internationally, and that's something they're executing on. That's way number 1 they're going to be growing. Way number 2 is through their FRC concepts, and specifically North Italia and Flower Child. Those are the biggest growth opportunities in the short term for this company. They're talking about as many as 22 new units planned for 2024. So massive unit expansion coming here for Cheesecake Factory over the next several years. Here, they also own other brands, Culinary Dropout, and some other brands. So, bunch of new locations going to be coming down the pipe over the next several years. The third way of growing this business that they're executing on is growing comp store sales, comp restaurant sales. So basically, just you're making more money from your restaurants, right? If we look at this past year, fiscal year 2023, 3% comp store sales were up to Cheesecake Factory. North Italia, 8%, and then FRC in general was a 3% gain in terms of comp store sales, average weekly sales per restaurant. Okay, so very impressive numbers. So that's 3 strong ways this company is going to be growing. You put all 3 of those together, Cheesecake Factory, international opportunity, all the new locations with FRC, and then your restaurant's doing more and more business, that bodes very, very well for you, right? Now, if we look at the kind of longer term outlook here, they're talking about 1 to 2% comp restaurant sales growth, which is not a hard number to hit. I think they'll be able to hit that pretty easily. 7 to 8% top line revenue growth each year. They're talking about 2 to 3% annual unit growth in Cheesecake Factory. 20%-ish type growth in North Italia, which they're going to be able to grow North Italia a 20% clip for many years to go in the future if they want. And then Flower Child, same exact thing, 15 to 20% unit growth there, much smaller square footage, so they could fit a lot more Flower Childs in locations that you just couldn't fit a Cheesecake Factory in, or even a North Italia for that matter. Fox Restaurant Concepts in general will be able to continue to grow a lot of those brands at a 10 to 15% clip. By the way, they just pulled in Flower Child into the Cheesecake Factory side along with North Italia. Now, next up here, think about this for a moment. And this is something I really realized with Cheesecake Factory that's such an exciting opportunity here. Cheesecake Factory has 3 for sure big hits in terms of big hit restaurant brands. When I say big hit restaurant brands, meaning like minimum of 100 locations, if not several hundred locations from each brand, because it can be that successful. They obviously have Cheesecake Factory. That's super famous. Everybody already knows about that one, right? North Italia, that's going to scale to several hundred locations. And Flower Child, no doubt in my mind now at this point in time, that will scale to several hundred locations over the next 5+ years. And so they have 3 legit, proven out, massive brands here. that you're gonna see in every single big city and many locations in big cities all across the United States of America and then international. Now, if I think about their competitors, Texas Roadhouse only has one right now. Texas Roadhouse has two other brands, and I own Texas Roadhouse stock, and it's done me tremendously well. But I got to be honest, when it comes to Texas Roadhouse, they own two other brands, and neither one of them I'm convinced is necessarily the next big hits. Bubba's 33, Jaggers, might be, but I'm just not convinced like I am in terms of North Italia and Flower Child. Chipotle obviously just has Chipotle. That's their one big brand. Darden does have three big hits on big brands behind them. Longhorn Steakhouse, they have Olive Garden, and then they have Yard House, which will probably push close to 100 locations here very shortly. Wingstop only has that, right? And Shake Shack only has that. So if I think about, when we go back to the start of this video, think about safe companies, I think it's pretty safe when I have, a diversified business model overall of ways to grow the business outside of just one brand. Because the problem in the restaurant category, one of your biggest risks is some sort of foodborne illness breakout, something like that. There's something that happened to Chipotle back in the day, and that took Chipotle stock from a $700 stock down to about a $200 stock in a matter of about 12 to 18 month span, because Chipotle had a really bad, let's call it, foodborne illness type situation many years ago. And so that's a risk there. If something like that happens, it goes viral, everybody hears about it, it can hurt a brand very negatively for at least 2 to 3 years. And I don't have that sort of risk with cake because I have three different brands. Imagine something happened at Texas Roadhouse bad. Oh my gosh, that'd be very devastating to that brand overall for at least 2 to 3 years. Now, the acquisition, this company acquired the FRC concepts. They acquired that back at the end of July 2019. Now think about this for a moment. This was, a mere 6 to 7 months before everybody started talking about Rona, right? Which was devastating to the restaurant category in general. And so a lot of people never really got to see this FRC deal, how big it would end up becoming over time. And I believe this is the best deal I've seen happen in the restaurant industry probably since Chipotle got full control and ownership and McDonald's departed from them, because that was really brilliant for Chipotle to have that happen back in the day. But outside of that, this is the best deal I've seen in the restaurant category in the last 20 or 30 years, to be quite frank with you. They were already an investor in FRC Concepts. They acquired the rest for about a little over $300 million. And I think long term in the restaurant category, this deal will end up being looked at as very similar to when Facebook bought Instagram, when Google bought YouTube. It's just like, can you believe they only paid that for it? And they changed that company's business model forever. And I believe that's exactly what you're going to see play out over this next 5 to 10 years in regards to cake. People are going to look back and they're like, oh my gosh, they got North Italia, they got Flippin' Flapjack and Flower Child and Culinary Dropout and these other brands for that little money. And those chains end up becoming massive things that changed the game for Cheesecake Factory overall, and maybe even became a bigger thing than their actual original brand. I think if you look out 5-10 years from now, people are going to be shocked by this. It was a game changer that changed the company forever. Now, the goalpost for cake overall is Darden Restaurants. Darden Restaurants is over a $20 billion market cap. This one owns Olive Garden, Longhorn Steakhouse, Yard House, and a few other smaller brands. And you look at cake today, it's under a $2 billion market cap. So this is a long-term goalpost that Cheesecake's really going after over these coming years. And so that's something to kind of keep in mind there. Now, if I look at the most recent year-over-year numbers, revenue grew about $136 million for the company, but gross profit grew $128 million for the company. So the profitability is increasing rapidly for Cheesecake Factory now at this point in time. If you can have, of $136 million in new rev, 128 of that hit gross profit, you're doing good. You're doing really good. Operating income went from $83 million to $149 million. And then net income went from $43 million to $101 million. 2022 messed up Cheesecake Factory's profitability bad. Natural gas prices went insane, which hurt a lot of the margins in the kitchen from an energy standpoint. Then on top of that, the raw cost of everything that goes into Cheesecake's products went sky high. And then the last component is wages went substantially higher. So that screwed up Cake bad in 2022. By the way, they still stayed very profitable even in a nightmare situation for them, to be quite frank. I mean, if you had to pick, would you take a recession or what happened in 22? You would honestly take a recession, because that was devastating to a company like Cake. So 2023 was kind of get back on the right track, and then 2024 is kind of expansion out as as you go into 2025 as well, right? Now, you look at the company, $101 million in net income last year, but it's way better than it seems. And the reason being is, a company like Cheesecake Factory has a ton of restaurants, right? So they have a ton of depreciation and amortization. Now, if you look at cash from operations, for instance, $218 million in cash from operations in this latest year, right? This line item alone, depreciation and amortization, was $93.5 million. So that's the thing to kind of keep in mind with companies that have big physical locations, whether it be, let's say, like a Wynn Resorts, like a hotel chain. You can take massive depreciation and amortization. You own a ton of different restaurants, you can take a huge depreciation and amortization number, right? And so, that all plays in before you get to the net income. And so it makes your net income not ever look as impressive as it could be. The net incomes are, let's just call it like, they're an important number when you look at restaurant chains or hotel companies or things like that, but they're not the whole story. Look at cash from operations. That tells you more of the story when it comes to these sorts of companies, right? If you own a SaaS business, depreciation and amortization is not nearly as big for you. But for a restaurant chain like Cake, it's huge. So overall, I wouldn't be surprised at all, outside of a major recession in the next 12 to 36 months, wouldn't be surprised at all if Cake doubles. And remember, it's a big dividend payer as well. So that's just kind of a little extra there. And it's been through everything. It's been through several recessions in its history. It's been through several high inflationary cycles and deflationary cycles. It's been through it all. So, and the worst case scenario, which was Rona, when their restaurants had to shut down for several months. And then when they finally opened again, they had to be limited. I mean, what a mess, right? Alrighty, so that was stock number 2 of these 4 stocks. Let's get into stock number 3. You know what it is. PayPal. PayPal stock. I'm very convinced the stock will double within 12 to 36 months. Now, in regards to PayPal, it starts with the forward P on the stock. It's incredibly low. It's on the floor. It's 11 times this year's expected numbers. It's not intelligent. That's all I'm going to say. They made a big mistake here with PayPal, a very large mistake, and you'll see over this next 1 to 3 years, this is a big mistake they made here, in my opinion. Now, if we look at revenue estimates, expect it to have revenues go up 7% for current year, and then getting close to 8% for the following year, right? So PayPal's actually a decent growth company. Is it the most exciting growth company? No. But that's pretty respectable growth, 7 and 8% expected, and especially when you're trading at these sorts of forward Ps, which are just laughable. Now, Alex Chriss just had his first full quarter as CEO, right, where he was there for all the months. They reported all 3 months. And what's interesting is if you go back for the last 11 quarters, he tied for the number 1 best EPS beat with a 12-cent beat there for the quarter. And the last time they had a 12-cent beat was Q3 of 2022. So he tied for number 1. And then he also had the number 1 by far best revenue beat of any quarter in the last 11 quarters with a $156 million beat on revenue. The next closest was right here in March of 2022 quarter. They beat by $75 million. So right off the bat, I would say Alex Chriss is off to a very strong start. Now, the more beats that Alex Chriss comes in with here, the more Wall Street's going to respect him and what he's doing and what he's pulling off with the company overall here. Now, a new CEO can make a night and day difference with a company. I think a good example that we have right in front of our face right now is Honest Company, right? And you had Carla come in from Amazon there, and she had other roles as well at General Mills and companies. And it looked kind of promising, but no one got that excited when she was announced CEO. And the first 6 to 9 months were really rough. it was kind of looking like, oh man, I don't know, is she actually going to be able to pull this off? Or is she just taking this company right down the tubes here, right? So her first 6 to 9 months was kind of rough, kind of like Alex Chris has been in terms of the stock price, right? But then as time ticked on, she's gotten to prove out that she knows what she's doing and the numbers are all heading in the right direction. Now everybody's jumping on the bandwagon. The stock has increased around 200 percentage points in just the past 6 months, right? And so I believe what's happened with Alex Chris is he's kind of in that 6 to 9 month kind of rough span when it comes to the stock price. And I think what's going to happen as time ticks on is more and more people are going to become believers as they see the numbers that, oh, Alex Chris knows what he's doing here and he's actually pretty legit. And so that's all going to play out this year, in my personal opinion, which is going to be very exciting for the stock price. Now, PayPal announced they're going to cut 9% of their workforce here recently, about 2,500 positions. Now, there's talk out there that this might just be one of several cuts this year, and there could be more coming overall. A lot more coming in terms of another bigger cut. And here's why. The company, a lot of people think unnecessarily, added way too many employees. If you look at 2017 they had 18,700 employees. And then you look at 2023, they had 27,200 employees, right? So there's a lot of folks out there that feel like there was such an unnecessary, crazy addition to the employee count overall. When you compare them against other fintechs, and keep in mind, PayPal is the big fintech, so they're going to need more employees than any of these other companies have. But with that being said, a lot of people are like, they don't need this many, because Block has less than 13,000 employees. Stripe, which is a giant, has about 8,000 employees. Affirm has a little over 2,000 employees, and Coinbase has 3,400 employees. And there you are with PayPal sitting at 27,000 employees. So let's say they cut it down to 24, 25,000. A lot of people are still looking and they're like, I think we can cut down to like 20,000. And so that's where a lot of people are kind of at here in regards to PayPal. And we'll see if they want to take it down there. I do have a little conspiracy theory that I think Wall Street's holding out for another big cut. I think that's why they're not buying up the stock. They're basically saying, do another big cut, announce another big cut to the workforce, and then we'll buy this baby up. I think they want one more big cut here from PayPal. So we'll see what happens with that, right? Now, I think there's a meta situation that's going to emerge here in regards to PayPal, where you're going to see costs decrease massively over this next year, right? As those employee cuts happen and other cost savings as well. But at the same time, you're going to see innovation pick up. I've already seen a major pickup in innovation in Alex Chris's team just in the last, I would say, 3 months. I mean, you can make an argument that they've innovated more in the last 3 months than the company innovated in the last 3 years. You can make a strong argument there, right? So costs are going to go way down. Innovation is going to go way up. Revenue could accelerate as innovation picks up and these innovative products they have and services, new things in the market come to fruition. You could actually see revenue start to uptick, which then leads to obviously a stock price that goes up massively. And I saw this play out with Meta. I've been part of it. We're sitting on nearly a $700,000 gain now, in regards to Meta stock. And I don't know if I see necessarily as big of a jump in PayPal, but I see a very similar situation. And I think by this time next year, it's going to be obvious to everybody. And I think people will be running over themselves to buy this stock overall. So yeah, I really like this PayPal setup, and I think it's going to double or more in the next 12 to 36 months. So, and by the way, in regards to PayPal, I think it's regardless of the economy, which is, pretty interesting. So, alrighty guys, next one up here, number 4 of these 4 safe stocks that will 2x or more in the next 12 to 36 months is Winning Resorts. Yes, a resort company. Oh yeah, baby. Win stock from 100 to 200 plus here. Now, in regards to Win, there's a lot of exciting things going on here. So if you look at the revenues of Win Resorts, $2 billion obviously back in the worst Rona year of 2020, and then went to 3.7, stalled at 3.7. They just took it to $6.5 billion this past year. That took gross profit from 880 to about, we can call it about $4.4 billion in gross profit. Now, the important thing to remember is, although the business model has trended back up in the right direction that you want to see, remember, we're still under the revenues we were doing back in 2018, for instance. and under the gross profit we were doing back in 2018 and 2019 as well, by the way. So I think that's a little food for thought that we're still playing catch up actually in regards to Wynn Resorts. And we actually haven't even come close to maxing out the numbers yet in regards to Wynn Resorts. Now, what's interesting here, if you look at earnings from operations, obviously it increased massively over the past, several years. But on top of that, if you look at net income, for instance, in 2018 was $572 million. They did $730 million in net income here in the latest year, right? In revenues and gross profit still hasn't even come back to those 2018 levels. So this year, you're going to likely see us eclipse or get very close to those 2018 numbers. I would say probably eclipse the 2018 numbers. So what do you think is going to happen with net income when we then have eclipsed the gross profit and revenue numbers of 2018 when we're already far exceeding the net income of 2018, right? That's a little food for thought in regards to that. Now, also the companies had 4 straight double beats in terms of their latest quarterly numbers, including an insane beat last quarter, 75-cent beat on EPS, which is ridiculous, ridiculous. And then a $101 million revenue beat. But look at that, 4 straight double beat quarters for this company. Things are looking very good here. Now, Macau, the important thing to remember is Macau still hasn't even fully recovered, guys. It hasn't even fully recovered yet. Last year, Macau got back supposedly to about 63% of where Macau was prior to Rona. 63%, right? This year, expected to get back to about 80% of where we were prior to Rona. So Macau's still in recovery, and Wynn's putting up these numbers while Macau's still in recovery mode. So imagine, at some point, Macau's going to fully recover and actually grow versus where they used to be in 2019. Imagine when that happens. Imagine where Wynn's numbers are going to be at in that sort of situation. That's fascinating to think about, right? Now, on top of that, for these resort-related companies, they take on massive loads of debt. They always have to pay a lot of interest on that debt. And when you're in a Fed hike cycle, some of the worst stocks to be in many times can be resort-related companies. Anybody that's got to take out a lot of debt, right? Well, the Fed hike cycle's over. It's all over. Jay Powell's led us there. It's done. Now we're about to go into a cutting cycle, right? The cutting cycle probably starts in July is my guess. We'll see. The cutting cycle likely starts in July and then will continue for several years, essentially, unless you get the massive recession or something like that before then they'll cut to zero like right away. But if we actually get the soft landing, they'll just slowly cut over the next 1 to 2 years, essentially. And so that is going to bode great for a stock like Wynn Resorts. If you look at Wynn Resorts, for instance, in 2009 through 2011, the stock went from $20 to $150. And that was during a bad economy. If you weren't around back then, that was a bad economy. Unemployment was super high. It was not a good economy, but yet the stock rolled. And the reason it rolled is everybody looked and they said, debt is very, very cheap, and that's going to bode well for Wynn for years to go in the future, okay? Hope you guys enjoyed today's video. I appreciate each and every one of you. Make sure you get that free workshop I got for you guys. That's pinned comment down there, how much you need to retire, quit your job, focus on investing full-time. All those good subjects are covered in there. All right, guys, much love as always, and have a great day.